Hi, everyone. I'm Angela Giroux, publisher of the Bauman Letter, and we are back with another edition of Your Money Matters. Of course, I am with Ted Bauman, editor, and Clint Lee, our research analyst, and we are going to have some fun today, so get ready. But before we get into that, again, if you're interested in finding out more about the Bauman Letter, there is a link below. It'll give you all the information you need, including, of course, how to sign up with absolutely no risk. But jumping into today, we are going to look ahead and we are going to be focused on opportunity for 2021, because there are only 21 days left in 2020. Not that I'm counting.
How many shopping days?
Oh, it's coming way too fast. It's coming way too fast. So today, gentlemen, I am going to ask you to actually put your money where your mouth is. If you could put your money into one opportunity for the next 12 months, what would it be? Before we get to that, just a quick reminder for anyone watching, we actually can't put our money into anything that we would recommend for obvious reasons, but we're going to put that aside for right now. We're going to have some fun. We're going to talk opportunity. And Clint, I'm going to start with you. If you had $1 million to put into the market, anywhere you want, but just one opportunity, where are you putting it? And just as importantly, why are you putting it there?
Yeah, sure. So I'll get to where I would put it, but just my thought process on getting there is I would keep trying to leverage and play sort of this weak dollar theme that we've been seeing here for a little while now. And one of the reasons I expect that to continue is, look, we still have Congress trying to hammer out a deal for another fiscal stimulus plan that's been a long time in the making, but we still don't have anything. And at the same time, the Fed meets this week for the last time this year. But the expectation right now and what they've been broadcasting is don't really expect any sort of expansion to what they're doing in terms of support they're providing to the economy. But at the same time, you have countries like Japan. Japan just recently announced their third round of economic stimulus, a $700 billion package. Just the other day, the European Central Bank came out and they're increasing their bond buying by $600 billion. So they're providing that support to their economy. We're still trying to find our footing there. And so that relative growth differential, that's where you're really starting to see the dollar weaken here yet again. And I want to show a chart of the dollar real quick, just to set up expectations, what I'm watching for. And now this goes back to 2012. And what I would look for is a decline in the dollar to sort of this 90 level that I'm highlighting from 2017. I think that'll serve as some price support here initially. And while we might see some sideways trading, I would expect that level to eventually give way and see renewed weakness in the dollar and start to target that sort of $80 to $85 range that I was trading at, back 7-8 years ago. And so with that, I would look to, once again, try to use that dollar as a booster to sectors, to investments that are already seeing a tailwind. So like an example of that would be something Ted and I talked about the other week in the metals space, in the commodity metal space. With copper and platinum, they already have some demand tailwinds coming about from electric vehicles, from renewable energy, while a weak dollar helps boost those commodity prices too. So that's an added benefit there. So with that, there's a couple other areas I'm watching. One I wrote about in the Bauman Daily just this past week, and that's with energy exploration and production companies. This is an area where I think the investor sentiment toward these names has just become way too negative. It overshot to the downside. And in fact, these companies have been stuck in a downtrend for over 2 years now. And I'll show you a chart here just to illustrate this point. So this is XOP. This is a exploration and production ETF. And it is traded below the 200-day moving average, this green line, just until recently, since the end of 2018. So that is a significant downtrend. And there's challenges to the oil space. We've talked about and recommended renewable names before, but look, this is a multi-decade trend in the making. It's not like we're going to wake up tomorrow and flip a switch and no longer need oil. So the demand outlook's getting a little bit better next year with the vaccine rollout. These names have just been punished too much. And you're starting to see that initial upturn in the share prices with this ETF now breaking over that 200-day moving average. And the added benefit is that a weak dollar is going to help support oil prices. And so this takes me to, ultimately the pick I would want to make here today, and it's marrying a couple of these themes. It's this commodity play. It's this stronger growth in international markets. There's a lot of international markets, especially in the emerging space, that have more attractive valuations. So putting that all together, that leads me to Brazil. Look at a commodity export driven emerging market economy. And I'll show you a chart here of the MSCI Brazil ETF, EWZ. And similar to what we saw with oil, we've been stuck in this downtrend for some time. This is just looking at the past year or so for Brazil. But, we've had this initial low back in March, April. We traded sideways for a while. That tells me that we're in this bottoming process, because now we're renewing this uptrend by breaking out of that green line, that 200-day moving average. And look, if I took this chart back even further, this ETF has traded up to around $100 a share before. I'm not saying we're heading straight back to those levels, but there's enough going on here to help move this ETF even further off these lows that it's been trading at.
Well, let me ask you, because obviously oil stocks in 2020 took an absolute beating. And if you're going to look at big oil stocks, Exxon was kicked out of the Dow. What is going to make 2021 so, and I realize we're not talking about Exxon, but we are talking about oil and exploration. What is going to make 2021 so different from 2020? And when do you think we could see that start? Because by all accounts, the first few months of the year is still going to be pretty rough globally.
Right. Yeah. I mean, you have to look at what is expected to happen ahead versus, stock prices aren't reflecting what's happening right now or what happened yesterday. It's the expectation. We've started to see the vaccine rollout in Europe. We're in the very early stages of seeing the vaccine rollout here in the US. So as we start to see normalcy return to the economy, that helps stabilize demand. And by that token, energy sector earnings just got absolutely pummeled this year, are expected to rebound back to a profit next year. So it's just those two things coming together with just how beaten down the share prices have been, just how negative that sentiment has been. And when you combine those things along with the support that we're seeing in oil prices right now, that's why this is a key turning point that you're seeing with those energy related stocks.
All right. So you've got $1 million on Brazil. Ted, where are you putting your million? Your imaginary million, of course.
Yeah. Just before that, I addressed that. I just want to point out that EWZ, the Brazil ETF, is one that we actually pointed out in the Bauman letter a couple of months back, I think even. So good to see that our call is working out there. Okay, here's my thing. Like Clint, I'm looking at sectors that are beaten down, but sectors that have an historical tendency to bounce back quickly. When a crisis is over. And I think that's precisely what we're looking at. That's the logic behind the energy thing, as well as the weak dollar. In our case, I'm looking at residential real estate investment trusts, or REITs. Now, REITs are basically companies that hold real estate investments on behalf of all their shareholders. And, they've been pretty beaten down this year, but there's a subset of REITs that, for example, we hold some in the Bauman letter that are oriented towards technical real estate, like, data centers, that sort of thing. And they've bounced back pretty quickly because they're related to the stay-at-home economy. But there's a whole nother set that people, I think, are scared of because they think that they're really, it's doomsday for them. And those are the ones that rent apartments. The problem is that, like everything else, not all apartments are the same. There are different types. I want to show you a chart of the S&P 500 versus two residential apartment REITs. The S&P is the blue line. The other lines are the REITs. Now, this is what happened during the financial crisis. Look at the numbers there. Everything declined up until January, sort of first quarter of 2009. And then look at what those two residential apartment REITs did. I mean, those are gains that anybody would kill for, right? And that's exactly what you got during that period. So that's the historical thing. I'm going to show you another chart now that shows one of those two REITs over a longer term perspective, going back to 95. And again, you can see that it dived very quickly during the financial crisis, but it recovered far more rapidly than the market as a whole. In this case, the orange line is the S&P 500. But look how much it's dived during this crisis. Everybody assumes that rents are not going to get paid, that people are essentially going to be looking at eviction, the landlords are going to be crushed, but that's not the case at all. In fact, I'm going to jump ahead and show you a chart that shows the residential rent collection through the end of October, and we're looking at over 99%, and that's actually, in some senses, a little bit better than the norm. So that's my play. Now, I want to show you a series of charts that basically make the case for these REITs, more specifically. Now, the first chart shows it's a 10-year chart, or rather, it's a longer-term chart. Look at how big a drop that one REIT has experienced. That's the bluish line. It has actually plummeted. It's gone so far below the market that it's almost absurd. I mean, particularly when you're looking at companies that have 99% of their revenues coming in. The next chart shows the year-to-date performance of the same REITs. Now, there's two REITs there. One of them is done a lot better than the other, but it's still below. But the one at the bottom, look how far down that is. Now, remember, I just showed you how they bounced back after 2008. The last one is a 5-year chart, which puts this a little bit in perspective as well. Both of these REITs are significantly below where the market is right now. But again, there's no real reason for them to be there. Now, these REITs typically pay out around 65, 70%. That's their distribution rate, which means that they're comfortable with their cash flow. Their funds from operations can easily cover their dividends. They pay between 3.5% to 5.5%, and they have a track record of raising their dividends on average by about 4.5% to 5% every year. In fact, the ones I've looked at have both increased their dividends this year. So with all of that, to me, that just smells like value. And that's like I said, I wish I could actually buy these recommendations, but I certainly would recommend anybody do that wants to look at. I haven't given you specific tickers. Can't do all the work for you, but that's where I think a big opportunity lies.
No, Ted, I'm gonna say something that I know we're not supposed to say because we're never supposed to say, but this time is different. But this time, isn't it different when we're looking at the recession from 2009 and then looking at today? It's such a different beast because this is a pandemic. So we're seeing this sort of mass exodus from urban areas. My sister lives in Manhattan. She has a country home in Connecticut. She left Manhattan in March and she hasn't been back. Mm-hmm. And I know she's not alone. Mm-hmm. So why isn't it different this time?
Well, first of all, I think you're right. I mean, the one REIT that I showed that has been beaten down quite severely, that is in fact focused on East Coast urban metropolitan areas. Okay. And yes, it is going to struggle a bit, but it's so far beaten down that even with the phenomenon you're describing, there are still tremendous upside there. Because it's over-corrected to the downside relative to its actual reality. I mean, remember, those rent collections are still very, very good. Right. They're, and they're still basically doing what they're supposed to do. And I think, part of the challenge will be not that they can't rent properties, but that the rents will be lower than they were. But remember that one of the advantages of residential REITs is that the leases are usually on a yearly basis, which means that as things bounce back and people want to go back downtown Manhattan, not necessarily downtown, but somewhere near the city, those rates are going to get bid back up again, and that's part of what drives up the rebound. The other REIT I showed you is more in cities inside the interior of the country, and they just have had no effect whatsoever. And a lot of these REITs focus on reasonably high quality renters that just don't. They have jobs. They're the people who are working from home. So I don't think this time's going to be different. I think it'll be different in that the upside is actually going to appear a lot faster than it did last time.
I like that. All right, well, we'll wrap things up. I see we could probably go on all day, but I did want to mention that Ted has finished up some reports on REITs that you could claim as a new subscriber to the Bauman letter. So when you click that button below, you'll see details on that as well. So please do so. And Clint, and Ted, if you run into that $1 million each, let me know. In the meantime, I will talk to you next week. Thank you.